Hello and good morning, folks. This is Almus Market Mornings, your daily dose of global financial update with me, Shikhar Garg. Now, a buoyant November month is about to end, and the final week is in for some action with the interesting set of data releases lined up. China's unrest and COVID situation has put the concerns on the demand from the Chinese economy, whereas we've seen People's Republic or the Central Bank of China reducing the reserve rates, as well as in their bid to add a stimulus of almost $70 billion to the economy. Now, Asian markets were seen having some sort of a correction, while the dollars were seen gaining some mild strength. We have NFP releases this week, along with the Fed chair, Mr. Powell, speaking, while the Indian Central Bank prepares for their MPC next week. So, JK, do we see the markets bringing back in action after the much needed breather from the holiday week?
Yes, I think the uh, sleepy mood from the market should change this week, definitely. And China has given enough reasons for that. In fact, talking to the streets en masse by hundreds of people in China, calling for the president to step down was thought to be unthinkable some time back. But after the recent dramatic protest in Beijing, bridge that stunned many, a bar appears to have been set for the expression of more open and sharper dissent in a country where a lot of ban is there on expression of free opinions, etc. And that said, I think the COVID restrictions, severe COVID restrictions, is definitely telling upon not only the economy but also the people's lives, and that is the reason why this has been triggered. And the unfortunate incident where people died because of not being able to get out of the houses, being locked in, was very saddening, and the protests were definitely justified, according to me. Chinese authorities will definitely do a lot of rethink on the way they have been approaching the issue. And so actually it's a good thing, not the event as such, but at least these protests are a good thing that the authorities would spring into action. And as you said, the economic side, they have released more liquidity into the system by cutting the RRR rate. And I feel more support for the economy will be forthcoming. So I think this is a crisis that China will get through in the coming days, and it is a political compulsion for them to actually address this. Otherwise, there wasn't much economic news in the last 2 days, understandably so, as US was closed. But we were looking at the Eurozone data, the latest being the GDP for third quarter coming at 0.4% versus 0.3 expected, and year-on-year coming at 1.3 versus 1.2. Looking at the evolving macro picture and reduced concerns on energy situation for the winter, it's expected that the recession in the region may be much less severe. ECB members have continued to sound hawkish, and there is a 50% chance still of a 0.75 hike, 7% hike by ECB in December, and that contrasts with about 71% of the people expecting a 0.5% hike in US. So there is a definite change in the relative interest rate or the monetary policy approach, and that could be an underlying support for the euro as well. Japan also reported the highest inflation in Tokyo region for 40 years, signaling broadening price pressures, and that would be something that can evoke a reaction from the Japanese authorities. Although so far they have maintained that wage increases will be the key for any change in the monetary policies. Yields held a narrow range overall for the last weeks, but stocks were positive on a weekly basis. Dow gaining 1.78%, S&P 1.53%, and Nasdaq was much less at 0.73%. For the week, dollar staged a small rebound, mostly pinned down to profit taking on hefty rise in the euro and the pound, but also soaring risk sentiment possibly due to China concerns. Australian dollar and Canadian dollar were bigger losers due to commodity prices falling, even as the global economy is likely to experience a demand shock. Dollar staged a small rebound, mostly pinned down to the events in China, as well as profit taking ahead of the key data that is coming up. Also, the expected speech by Powell in an event on on 30th of this month, or rather on the Wednesday, is keenly looked for. This is the first public appearance or the speech that he is going to give after the FOMC press conference. The key levels to watch on the dollar would be euro at 1.0382 on a weekly closing basis, GBP at 1.2175, and dollar index at 1.0537, all of which are also 200 daily moving average levels. And that on a medium term basis, break up these levels usually take some time, and some consolidation should be expected in these currencies. Rupee seems to be actually seeing an upward pressure against the dollar, although gains are still being challenged by imported demand on dips. The forward premiums falling to new cycle lows is not helping the rupee, but eventually the expected flow should see the currency weather the current weakening bias and see more sustainable rebound towards 81 or lower. We will have more to talk about as the week progresses, because we are seeing a slew of economic data ahead. Thank you.
Okay, JK, and that's quite good. I mean, yes, we are expecting a slew of economic data, as JK mentioned, and which can bring in some sort of action into the financial markets. But on the other side, as JK mentioned, there's an unthinkable protest by the Chinese against their existing set of political setups of the governments, and it's the sort of a political compulsion now for China to, resolve this issue at the earliest now. And yes, another thing is the definite change in the monetary policy action and the expectations on the European side. Folks, that's not it. We have the Fed Chair Powell coming in, and he can provide some sort of surprise for the markets. As of now, we are seeing small upticks on the DXY, while the dollar strength is pinning down rest of them. So that's it for today, folks. We shall come back again with another round of fresh updates tomorrow. Thank you so much for listening.